morning. Today we'll be doing another stock analysis. As you can see, I'm slowly trying to build a little bit of a setup here that looks at least a little bit professional. I just got this microphone for my birthday, and I think it works pretty well. But anyway, today we will be going into Dropbox and seeing what they've been up to. So I don't think I've reviewed the company before. If I did, it was a while ago. But yeah, we're going to be getting into Dropbox today, going through their financials, a couple other things. So make sure to subscribe and let's get into it. So, getting into Dropbox today, they have a bunch of different software applications founded in 2007. They basically do file sharing and things like that. So, looking at some industry metrics, net ads, I'm assuming, is the amount of users they have. And as you can see, they're projected to actually lose users throughout all of 2025. Average revenue per is expected to decline slightly. Annual recurring revenue is also expected to decline, and paid users is expected to decline as well. So honestly, not great for the industry metrics here. I would say this is probably the most important part, honestly. So not great there at all. So $7.7 billion company, no dividend. Target price is at 28 currently, and we do have a slightly negative long-term growth rate. So with the current price of $25 a share, it is a little bit under that target price. And looking at the chart here, you can kind of see the company has been lagging the overall market for a while now. Obviously, there are some swings that have been going along with it. But overall here, there isn't anything too crazy. It seems like they're prone to pretty big drops, especially recently. Let me get the whole chart up here. So this is their entire chart since they've been public, I believe. And yes, it is. So overall, they really just haven't been able to gain any traction in terms of adding value to the company. At least that's what it seems. And especially this last earnings report, they just got absolutely annihilated. So we are going to get into that in a moment. First, let's look at the growth summary. So we do have a mostly positive growth summary here at the very least, which is good. Sales numbers are a little bit low, but either way, it's mostly positive. So I would take that as a overall positive. And now let's move into the financials. But first, I'm going to go over their most recent earnings. So revenue up 1.4% year over year. So not the best. Up 1.1% year over year for GAAP. Operating margin of 13.7%. Free cash flow of 210 million. So let's just keep moving through here. So we delivered solid results and made a lot of progress by bringing our AI powered product Dash for Business to market and restructuring our core business to be more efficient. Looking ahead, we'll continue our strategy of scaling that. So it looks like they have a new AI product that they're working on scaling, as I literally just read, and integrating that to deliver greater value to customers. While it's still early, there has been positive feedback that seems encouraging. And validating the need for practical AI-powered tools. So overall, I would say that is a little bit positive. Clearly, they are in a restructuring phase, and I think the stock price really shows that without too much growth long term at all. So that's kind of to be expected. For fourth quarter results, I'm looking to see if there are year over year increases that we can look at. So I think everything has it. So we're just going to go through. So total ARR was 2.5, increase of 2% year over year. On constant currency, year over year would have been 1.3%. Total ARR decreased 4.8 million quarter over quarter. Paying users was 18.2 as compared to 18.1 from last year, so a very slight increase there. Average revenue per was 140 compared to 138 the year before, and paying users decreased by 15,000 quarter over quarter, so slight decrease there. So it looks like over the past year, they did have some fairly solid growth. However, the projections going forward are for them to essentially lose all of that growth based on what I saw. Now, will that actually happen? Possibly, but there is always the chance of that not happening and them turning this around. So those industry metrics I said at the beginning were very important. It could be just completely the other way around. Those are estimates. So keep that in mind. Other than that, if you want to read through everything else, go ahead. I'm going to move along here. So share repurchases announced the new share repurchase program for $1.2 billion of its common stock. Now, if we go back up here, that is actually massive because this is only a $7.7 billion company. So that much of a share repurchase is going to have a huge effect on investors, a huge positive effect on investors also. Repurchase. Okay, so there's not a strict repurchasing plan of when it will be happening. It will just be made time to time. They've just authorized an additional $1.2 billion to be repurchased, based on what I'm seeing here. So anyway, moving on, full year results. We kind of already looked over that. Financial outlook, there's nothing too crazy, and there are some financial statements here. I will not be getting into those just yet. So looking at the metrics recap, let's just go over this right here. So gross margin 83.1 came in within estimates. Operating margin actually beat slightly. Deferred revenue came in a little bit under the last quarter, which is perfectly fine. Cash from operations came in a little bit above estimates. Free cash flow also came in above. Paid users was slightly off, but still a year-over-year increase. And average revenue per user came in a little bit above. And ARR, I wish I knew what ARR meant. Average revenue recurring, possibly. Not sure. But that also came in a little bit above estimates. So overall, there has to be some kind of guidance here. That is the reason their stock price dropped so much. And I'm trying to find it, but I'm not seeing anything specifically in here that talks about the guidance. Was hoping to see it. It seems like I'm not going to be able to. Financial outlook, forward-looking guidance on its conference call and on its investor relation website. Well, why don't we just head on over? Oh, yeah, that'll do it. So anyway, I'm assuming the stock dropped based on negative guidance. But anyway, let's get into the financials here. So we do have full year 2024 data. So they have been seeing fairly steady sales increases, although the past year it was very slight. Cost of goods sold did come down in that time. SG&A expense also came down in that time. So there is a little bit more efficiency going on here at the very least. However, their net income was also lower. Operating income was much higher, but net income was lower. So a little bit more operating efficiency, but overall, end of the day, they came in with less money. So take that as you will, but overall, not great. Either way. So other than that, you can see their total shares have been massively coming down over the past few years. They're currently at 295 million. That is down from well over 300 million, actually 400 million a couple of years ago. So they are doing that positively at the very least. However, I feel like that money could definitely be better spent investing in sales growth, just based on the fact that that's slowing down now. But we'll have to see how they pivot in the future to kind of make up for that lost demand. Cash situation looks okay. Very little short-term debt, not a ton of long-term debt either. And they do have a fairly good ratio of cash to long-term debt, so there's no real concern there. Assets have been growing. They're at their all-time high asset value at the moment. And I would say that is not completely driven by cash, although it kind of is. Most of it is. There are some intangibles that they're at their highest level of that as well. And property, plant, and equipment is also at the highest levels. Or actually, no, it's not. Not even close. So overall, take that as you will, but all-time high in assets is usually a good sign. However, also the revenue is slowing down, so could be negative. We'll have to see in the future. Moving on to cash flows, let's see how they're doing here. So operating cash flows are increasingly positive. Okay, so this is a fairly good sign compared to their sales growth. So their operating cash flows have massively increased. They did sell off a ton of investments over the past few years, so their investing cash flow has been positive as well. As they're doing this, we are still seeing sales growth, although not much. So usually I would say it's a negative thing when they're selling off parts of their business, but considering they are still slightly growing, I think it's okay while they're doing this sort of restructuring towards AI. And then financing activities, there was a fairly significant amount of debt issued in the past few years, but just looking at these stock repurchases, this is massive. Their company is only worth, I'm pretty sure it's 7 something billion. I already forgot, but repurchasing this many shares, there's going to be almost none left at this point. But that will do great things for their share value in the future, which is awesome. So Anyway, free cash flow aggressively positive and actually the highest they have ever seen at the moment for 2024. So overall, I would say that's very solid. Going back into the chart here, I think it will do essentially the same pattern here. However, just based on the fact that most of that earnings report was fairly positive, I think they can see a recovery. I honestly always thought that this company was much larger than it is. So the fact that it isn't is kind of surprising. But anyway, another metric I've been looking at recently is their total number of employees. Now, I will say with a software company, that's not as important as it would be for maybe some other companies like manufacturing or possibly retail even. But it is still an indicator of kind of where the company is, because usually if you're growing aggressively, you're adding more to your workforce. And as we can see here, Dropbox over the past 2 years has decreased their workforce by well over double digit percentages. So that is not great there. But just the last thing I wanted to cover there, they have been very significantly reducing their workforce, which could be a negative sign, could be just a part of their kind of pivoting, restructuring program that they've been doing. But anyway, that is all I have for today. Thanks for watching. Make sure to subscribe if you haven't, and I will see everybody in the next video.